Welcome to the 2026 version of the virtual home buying seminar. And today's topic is refinancing. So, welcome to the call today. And I'm excited really to get into this topic. Depending on the rate environment, refinancing could be as much as 50 or 60% of our volume here at Michigan First. And we have two of our subject matter experts joining us today for that. My job today is to act as your host and guide the conversation. My name is Dan Sugg. I'm the Chief Mortgage Lending Officer here at Michigan First, and this is in my 10th year here at Michigan First. The bulk of our conversation and the format today really is to have this conversation around the benefits and certainly the process of what it takes to refinance your mortgage. When we take a 30-year mortgage out, we don't always think about what refinancing option we may have, and we hope to give some of that information to you today. So without further ado, let me jump into our introductions. Joining us today is Michael Zuber. Michael is a loan officer with Michigan First Mortgage and works out in our Rochester office, but certainly covers a wide area of availability. So I'll let Michael tell you what makes him special and why he works at Michigan First. Michael?
I've worked in the mortgage industry since 2013. I've spent really the majority of my career in operations leadership in mortgage. So led just about every type of operations team there is. So I got a strong background on moving loans through the process, guidelines, things like that. Outside of work, I've lived in Michigan my entire life. So, working for a company that really is focused on the state is big to me. And, big Detroit sports fan. Love playing sports, big Tigers fan, Michigan football, Lions, all that. So
I have to know about the bagels, Michael. What's the story there?
yeah, so I started making bagels a few years ago, and it's actually been a huge driver for my referral business. Us loan officers here at Michigan First, we solely work off of referrals. So I take bagels to all my closings. I take them to the different branches. I take them to real estate offices. It's been a great way to network. People love them, and it's been a great way to drive business. I have sourced 400 leads since I started with a
Wow.
lot of it, the bagels.
Did that come out of the pandemic? You needed a hobby, or was it just you were looking for a new?
Um, Honestly, I first made them for my fiance for her birthday. She's a big bagel fan. And then I wasn't like super happy with how they turned out. And then I just kept tweaking the recipe and kind of really fell in love with the process of it. And then we're big fans of going to New York City and eating bagels there. So just trying to get it as close to authenticity or authentic as possible.
Yeah, that my algorithm on social media is filled with donuts and bagels. I don't know why. I think maybe says something more about me, maybe. But all right. Well, thanks, Michael. We appreciate you joining today, and I can't wait to jump into the conversation. Our next guest and subject matter expert is Grant Spencer. Grant, if you would, he is one of my mortgage branch managers here, our sales leaders here at Michigan First, and has been with us for a while now. So, Grant, tell us a little bit about yourself and what does those initials behind your name mean?
So, thank you for the introduction. I appreciate that, Dan. The initials after my name are CMB, which stands for the Certified Mortgage Banker designation given to us by MBA. It is the highest designation in our business and signifies excellence and a real high level to the mortgage industry. Not just that we do mortgage sales, we're here to go ahead and support American homeowners across the board and the industry to be able to provide better environments for everybody. A little bit about me. Funny enough, somebody asked me this earlier today. So, this is my 24th year in the mortgage industry. I've been with major banks, New York lenders, IMBs, etc., and been in leadership for the majority of that time, building sales teams, creating processes. And it's funny to me that here in year number 24, I had originally got into the mortgage industry when I got out of college, thinking to myself, you know, I'm going to get into this mortgage thing for about 6 months and pay off some bills, and then I'll figure out what I want to do with my adult life. And here I am, almost a quarter of a century later, sitting here talking to you about how much I love the mortgage industry. And my tagline is this, and it's just the God's honest truth. My job is to make positive, lasting impacts in my clients' lives to be able to put them on the track for success overall.
This is a industry built on passion because of that, essentially that notion of providing home ownership to people, and it's been certainly many generations of lifelong dream to get there, and being a part of that, our part of it, providing the financing and the guidance and the counseling along the way of that and making that become a reality is the reason why most of us cannot leave this industry. It is something that is intoxicating and makes us very sticky if you think about it. So, well, before we jump into the refinance piece, I would love from each of your perspectives, what's going on in the mortgage market today? Tell me a little bit about what is the environment and what are we seeing? And I think I'll start with Grant.
Current mortgage market here in Michigan. We are truly blessed as far as our housing market around Michigan. Currently, as of the last 18 months, there have been pockets of the country that we have seen depreciation within their markets. I think of Austin, Texas, and places down south that are currently seeing some depreciation across the board. And the inventory levels down south and out west have really come up quite a bit. But let's talk about here in Michigan because that's what's important to our members. Here in Michigan, we still have some limited inventory. We are seeing more homes come on the market as of right now. However, we are actually now seeing our buyers get traction and get into homes. The of years past where someone might have a home they're interested in and be fighting against 15 other offers on the table, while still evident sometimes, has certainly curtailed quite a bit. And we're starting to see a lot of our membership go ahead and be able to obtain that dream of home ownership. We here at Michigan First offer a lot of different programs that aren't available wider in the mortgage business, such as down payment
Right.
assistance programs and some of our turning point loans that allows members to go ahead and make those impacts into their lives to be able to do home ownership. We're seeing brisk business. Things are turning up, and truthfully, after the last couple of years of things being different than that, we're grateful in the fact that we're able to go ahead and help more of our members be able to go ahead and get into those homes.
Definitely seen an increase in applications recently, wouldn't you say?
Certainly, without a doubt. I think as of right now, when we set our targets as a business throughout the year, we have certain quotas and metrics that we want to be able to make. And right now, as of May going into June now, it's hard to believe almost half the year's over. We are exceeding those metrics each and every month, which we are eternally grateful for, certainly. And that's because
Yeah.
of the members that like, know, and trust us to be able to take care of their financial needs to get into a home.
Yeah, consumer confidence is on the rise too, and certainly you touched on it very early in Michigan. We are insulated from the very highs and the very lows when it comes to the real estate market because we are a more conservative state. So, Mike, I didn't mean to tuck you off. I'd love to hear a little bit about that and talk about rate too. Where are we seeing rate environment recently?
Yeah, so I mean rates, I mean I think what they probably hit their peak, guys. What do you think? Sometime last year, maybe 2024, end of
Sure.
2024. So really we saw like I think pretty steady decline over the last I would say year. I think there's some different things going on right now. I mean, you turn on the news, there's a lot of stuff going on in the world right now, and always is having an impact on rates. So, I think in the last month or so, we've seen them come up a bit. I know, I was just over, I spent some time in Europe and like doing some quotes on rates before I left for my trip. We were seeing rates as low. I mean, some people were dipping into like the high fives and then coming back, kind of jarring. Saw some
Yeah.
increases there, but even since then, just in the last week or two, I've seen it come down a few basis points or a few percentage points. So the market I think is a little volatile right now. There's a lot going on with the wars, and other things that are affecting it. But I also say the same thing with like the housing industry in Michigan. It's like kind of depends on the market and the area. But like I think I've seen a lot more folks where, they've just been searching for a house for a weekend or two and they're putting an offer in, they're getting it accepted right away. But on the other side of that, I have a client shopping in like a more rural area right now. And I think they put in 8 offers. They've looked at some 50 houses. So it can be up and down depending on, what purchase price you're at, what area you're looking in.
Yeah. And if you think of certainly that kind of double-ended spectrum you just talk about is that it really is very much local. It's where you're at in your situation that will drive that. And what a great segue to talk about this little blip in rates that we've seen, really what I would call an artificial rise in rates, given the kind of the financial stoppage we're seeing in the Strait of Hormuz and a couple other things has really driven this artificial market correction we've seen, and those will come back down. But if you were to buy a house today and rates, let's say maybe are 5/8 or almost a point higher than maybe what you could have got a month ago, what are your options? So like this term refinance, what does that even mean? So maybe we'll start with Grant. Grant, what are we talking about? What is this option for refinance if I have a mortgage? I
So,
took out a 30-year loan. I thought I was going to make the same payment for 30 years. Like what are we talking about?
um, lots of questions there, believe it or not. So let's start with the first one. It's always a good time to buy a house, regardless of the interest rate. And here's the argument for it. Homes, unlike a lot of other assets you're going to earn in your life, they appreciate over time. So that asset, that home you buy, not only are you going to go ahead and put your head down there at night, raise your family, be part of the community, but overall, that value of that home goes up over time. So getting into it and purchasing and holding that asset is going to serve you so well, regardless of the interest rate on a home. Now, let's talk about what it looks like long term. As of right now, I believe this still the most Americans, by and large, on average, hold a home between 7 and 8 years before they end up moving on to something else. So during that time that you own the home, rates always change each and every day. So let's talk about you buy something today in the mid 6% range and that you got a budgeted monthly payment that you can afford each and every month to protect you and your family and get into that home. Well, over time, rates fluctuate, and we expect here in the next number of years that rates are going to fluctuate downwards. So that same money that you borrowed to go ahead and purchase your home is actually going to be available to you at a cheaper interest rate, which means a lower monthly payment to you. And that's where we come in here at Michigan First. Our loan officers are trained to go ahead and have a relationship with our members for life so that when an opportunity arises for a member to go ahead and reduce the interest rate that they currently have on their mortgage and hence reduce their monthly payment over time, we're going to have that conversation with them to put them in the best financial situation possible. And that's really what the expectations are here for the next 18 to 24 months is that rates are what they are for the time being. You take advantage, you purchase the home, you get yourself in there, and that over time, those opportunities to go ahead and refinance and drop your payment are going to occur. That's why you want to stay here with us here at Michigan First and keep that relationship for life.
Well, Grant, let me ask Michael this question because if I'm thinking about this correctly, let's just say that I bought my home in 2019 and I'm now thinking about the rate is less today than it was in 2019 and I want to refinance. Grant just told me I can refinance. What happened to all those payments I made for the last 7 years? Michael, am I losing all of that? Like what happens?
I mean, not necessarily. I mean, it really depends on like the term that you're going to go with. If some people think that, right? Like, I'm going to refinance my house. I'm going to lose all those payments I made. If you bought in 2019, so you're 7 years into your term. So, you've probably into a 30-year mortgage. So you're thinking, wow, now I'm going to reset and I'm going to have another 30 years of payments. Well, you can actually set the term that you'd want to set. So, um, you wouldn't necessarily be missing out on those payments. As long as you don't extend that term back to 30 years, then, you're going to be in a situation where you are kind of like resetting that timer and going back. But, if you refinance into a shorter term at a lower interest rate, I mean, you're paying off the loan actually sooner and, those payments weren't all for nothing.
Let me rip off of Mike for one quick second, too. In your example, Dan, somebody had owned that home for 7 years, had been comfortable with the payment, was able to budget for it. When rates are reduced, a borrower could simply go ahead and refinance the existing mortgage and drop the term that they have on the loan. So no longer you're at 23 years. Let's look at a 20-year option or maybe even a 15. The payments will be pretty similar to what you're currently comfortable with paying. And now you can pay off your home that many years faster, saving you tens of thousands of dollars in interest over the term.
Right. Another thing too is like if you didn't put 20% down in 2019, you probably built out a ton of equity because home prices have really increased over the last 6, 7 years. You could be refinancing yourself out of that mortgage insurance premium and saving yourself, hundreds of dollars a month just right off the rip from that.
Okay, so what kind of refinance is that called? Like if I'm just lowering my rate, what do you call that?
That's a rate and term refinance. So there's a couple different kinds of ways you can refinance.
Okay.
You can also do what's called like a cash out refinance. A lot of times people leverage this if, say they fall into some credit card debt. I was working with a member a couple of months ago. She had $50,000 in credit card debt.
Okay.
She had,
Yeah.
with that said, she had, over $200,000 in equity in her home. So it's like, you got to look at it realistically. It's like she's looking to retire in the next 5 to 10 years. There's no way she's getting out of that hole with the credit card debt. The 50,000, just making minimum payments, you're really never going to get on top of that. You can start chunking it off, but you're probably paying, sometimes up to what, 29, 30% interest on some of these credit cards. So, being able to refinance, leverage the equity you have in your house, get those credit paid off, and then now you're paying it with your mortgage note at say 6.5%. You can spread those payments over a longer term, making it so, like I think she was paying something like $800 or $900 a month in just minimum credit card fees. We were able to lower her mortgage payment, include her credit card debt. I mean, I think she was saving by the end of it over $1,000 a month.
Yeah. So you mentioned, oh yeah, housing price appreciation over the last year. So like if she would have bought that house, let's say 15 years ago for 150 grand, potentially that could be worth a lot more today. Is that what you're saying?
Yeah, definitely.
Yeah.
I mean, if you bought something $150,000 in 20, what you said 15 years ago, those
Yeah.
houses are probably going for 300,000 now.
Okay. So yeah, because of all that appreciation, sure. So then any of that available equity. So if I just kind of do in my head, my house is worth 300 and I owe 100, you can borrow the kind of sum of that difference back, right? Is there a limit on how much I can borrow?
Yeah, so you can borrow up to 80% of the equity in your home. So, once you get into process, you're going to have an appraisal ordered. You'll be able to borrow up to 80% of that appraised value. If we're talking about a single family home, primary
Right.
residence, obviously you're going to have to subtract out what is left on your current mortgage note. And then whatever the difference is really like the amount that you kind of have to play with. You could use that money to pay off debt. You could use that money to fix up
Oh,
your
wow.
house, put a new roof on, whatever you see fit.
And generally speaking, any of the payments I'm making today on my current mortgage will look similar to what I'm going to do, right? I mean, my taxes and insurance, all of that kind of stays the same if I'm escrowing today.
I mean, your taxes and escrow, would not change with the refinance.
Okay. So my current mortgage is with, I'm speaking in third party right now, but my current mortgage is with XYZ Bank in Monroe, Louisiana. It got sold 9 times. Where do I even start to try to figure out who I should go with? And can I switch lenders? Like, how does that work? Like, would Michigan First help me with that refinance, even though I'm with a different bank somewhere else?
So at the end of the day, a borrower needs to go ahead and work with somebody that they like, know, and trust, that they have their best interests at heart. And that's what we do here at Michigan First. Being a not-for-profit lender, we offer options that are far less than any of the other lenders that are out there. But the truth is this, you as a consumer can select whomever you wish to go ahead and refinance your home to. And one of the neat parts about being here at Michigan First, something I take pride in, is to your point, Dan, you'd mentioned that somebody's home servicing, right? The guy you make your payment to each and every month, you closed all those many years ago, and now it's been sold to one guy to the next, to the next, to the next, and you're getting these letters every so often saying, Hey, so and so is no longer your mortgage servicer. Make your payment to me, and you have no idea who they are. You have no relationship with them. We here at Michigan First, we don't do that to our members. We retain the servicing here with us. So when we do a loan for you, we close it. We're going to maintain that relationship with you over the long term, and you're always going to make your payments to here at Michigan First. We're only a phone call away if you have any needs in regards to your mortgage.
Yeah, I think the trust thing is big too, because I mean, I've had borrowers come to me 6 months after they purchase saying, "Hey, I heard rates went down. Let's do a refinance." And it's like you quote it out for them, and it's like, okay, like you could save about $40 a month, but there's going to be closing costs associated with doing a refinance. Like you really want to figure out what is the break even point. And if that's 5, 6 years down the road, maybe a refinance at this time doesn't make sense. Like we've kind of talked about, we're really in like a declining rate market. We should see rates continue to come down. So it's like if you go to refinance right now just to save $40 a month, you may miss out on an opportunity to refinance, say, a year after that, where you could have saved more money. You've kind of wasted those closing costs that you did on the refinance.
Wait, so is there a limit on the number of times I can refinance?
No, but I guess what I would say is just like from a strategy standpoint, like, if you spent, say, 4,000, what would you guys say the average cost is on a refinance closing costs?
Uh, 3,200 bucks. I don't know, maybe a little less, depends on your loan amount.
Right. So let's take it, what, $40 a month, $3,200. What's our break even point then? Like 80 months.
Yeah,
So
not
80
far off.
months, what is that? A little shy of 6 years, 7 years?
7 years. Yeah.
Yeah. So, I mean, if rates come down, say much further down during that 7 year period, it's like you're going to be paying again to do that refinance where you definitely can still do it. It's just maybe it's not going to be as advantageous.
Yeah. Okay. I get it now. And there might be some other strategies you can use actually to add additional principal and things like that. That's cool. So I guess it really depends on why you're looking to refinance. So how would one of our members know it's a good time to do a rate and term refinance? Obviously, cash out is kind of self-explanatory. You have a need. I got some credit card debt. Maybe I want to help my kid with some college or pay for a wedding. I have a need for cash, and you can start to figure out what the best way to get that cash is. But from a rate and term refinance perspective, how would an average consumer or member know it's a good time to refinance?
From a homeowner's standpoint, when is an opportunity to simply refinance and lower your rate through a rate and term refinance and put you in a better financial situation? A couple things to know. One, be cognizant of the talking heads on television each and every day. Oftentimes we hear about rates coming down from those CNNs, C-SPAN, Fox News, etc., folks, quite often, right? And you're going to hear it around the water cooler. Your neighbors, your friends, people will think and talk about that. If though, for those who are really interested in finding out how rates are doing, we in the mortgage industry, and not to dive too deep here, use something called the US 10-year Treasury bill to calculate what rates are going to be. We use something called the yield. When that yield drops, that's when interest rates on mortgages are coming down. So just be cognizant of the world around you. Listen to those that are around you. For those that like to watch the news, the 10 years is a great way to do it. But even better, stay in touch with your mortgage loan officer. We have a relationship for life with you. There's never a time that you can't call us to ask us the question of, can I go ahead and put myself in a better financial situation with a refinance? And many of our loan officers here track your closed interest rate that you have on a mortgage with us, and we'll proactively reach out to you if there's an opportunity to put yourself in a better situation.
I'll take my consumer hat off for a second. It's interesting to ask people on an average, what do you think your current mortgage rate is? Most people do not know. They think they know. Like it's, I don't know, it's three something or four something. It's in there somewhere. So, it's like one of those things that you did 7 years ago and you're like, I think I remember what it is, but I think I would start there. I would look at what your current mortgage rate is, what you think your home is worth, and what you currently owe. Those three facts. And then I think call your no like trust partner in Michigan First and say, hey, what do you think I could do on my mortgage today? And there's so much more than just saying what's my rate to rate shopping. If you don't have those three pieces of information, nobody should even give you a rate, because certainly those, and what your credit score is, because those can all influence what your opportunity is to refinance. I bought my first house. I'm going to come up with another scenario. I bought my first house in 2022 and I did an FHA mortgage. And man, I bought in an up and coming neighborhood. Michael just told me that my values have gone up at least 40, maybe 50%. I would love to get out of that FHA loan. Can I refinance that FHA loan, Michael?
Absolutely. And you don't have to refi into another FHA loan. You can switch to
Oh,
conventional.
so I can go to a conventional, like go on a Fannie Freddie mortgage, a conventional loan too?
Sir. Yeah, I
Wow.
mean, as long as your credit score meets the guidelines and your profile qualifies for conventional, you could refi into a conventional loan. If you have the equity in the house, we could be refinancing you out of that mortgage insurance premium as well.
Very cool. So is there a penalty to refinance out of an FHA loan?
No,
Okay, because I know I paid some upfront mortgage insurance. I didn't know how that all worked on an FHA loan, but I think you can probably get that rebated back. I don't know, Grant. Do you know how that works?
Yeah, when you refinance out of an FHA mortgage into another FHA and or a conventional mortgage, FHA through HUD will allow you to go ahead and rebate part of that upfront mortgage insurance premium that was rolled into your loan to begin with. Just ask your loan officer about it when you go ahead and have that conversation. It's a sheet. It talks about the time they've been in the mortgage since that loan started. We'd be more than happy to go ahead and have the conversation with you and let you know if there's any opportunity to save a little bit of money on that rebate.
Great. All right, if we think about the types of mortgages, we've talked about conventional and FHA. I heard something about an adjustable rate mortgage. Maybe now is the time if it's high. Should I be looking at an adjustable rate, or if I'm in an adjustable rate, can I refi? Who wants to take that one?
I would absolutely take that all day long. An adjustable rate mortgage is a fantastic option for many borrowers. The reason why, for a number of different reasons, we talked before about the average homeowner being in a home for maybe 7 to 8 years. That's a pretty true statement across the entire country. So you think to yourself, well, first let me set the context, right? An adjustable rate mortgage tends to have a lower interest rate than a long-term fixed rate mortgage. The idea being that the lender only has to guarantee the rate for a specific period of time, so therefore the risk is lower and they're going to go ahead and give you that benefit. Well, if you know that you're not going to be in a home for maybe more than 5 or 7 years, we can tailor an option for you at a lower interest rate to go ahead and take advantage of those savings to put back into your investment accounts, pay off additional debt that you have, put into your savings to help your family. And the cool and great part about an adjustable rate mortgage is that in an environment where rates are higher and they expect to come down, which is where we're at right now for about the next 24 months, taking advantage of an adjustable rate mortgage now could save you hundreds and thousands of dollars over the term, knowing full well that in the next 2 to 3 years, you may take advantage of a rate and term refinance. And if the case is that you're going to stay in a home for an extended period of time, that's the time that you can take advantage of something that might be longer term or fixed at that point, if that's your decision. Or you could always just refinance into another arm for another 5 or 7 years and take those savings and benefit yourself in the long run. So they are a fantastic option, truly something to talk to your loan officer about.
Michael, what do you think about that?
I mean, I can't disagree with what Grant said. I mean, I think he hit most of the bullet points there. Um, I think the only thing you have to worry about is like, I mean, I think what adjustable rate mortgages kind of got dragged through the mud there during like the housing crisis and like the early 2000s. But that was a much different market than where today's market's at. Like Grant was saying, we're kind of in a declining rate market right now. There could be future savings once the rate does adjust, and you generally get a better deal from the lender.
It feels like arms are starting to come back a little bit. And I think that's driven a little bit by our rate environment. Certainly about 80% of what the industry does today is in a 30-year fixed rate mortgage. So arms do play on those fringes a little bit, but for the most part, I think Grant hit it on the head. The average length of a mortgage has always been about 7 years. Right now, we're touching 7 years since our last big refi event. So those are starting to now age a little bit, 8, 9 years going out from when maybe somebody had the last chance to refinance. But if you did an arm in 2020 when rates were very low, that arm is going to adjust up right now. So certainly looking for an opportunity to refinance would be good at that point.
And let's just address the elephant in the room, right? An adjustable rate mortgage or ARM, when people sometimes hear that, they immediately go to the worst case scenario is that after that fixed period of time that I have an ARM, that my interest rate is going to go up on that mortgage and that's going to increase my monthly payment. Well,
Yeah.
the converse is true as well. Some people, when they take ARMs over the fixed period, if they continue to stay in it, that interest rate adjusts down. And just to prove the point and talk about it a little bit, folks who took ARM rates back in 2012 and 2013 after their fixed period of time actually saw their rates drop down into the 2% range each and every year from there going
Yeah.
forward. So the opposite is true as well. They are a great opportunity to succeed in the end. Have that conversation with us. Educate yourself. You really could be saving tens of thousands of dollars over the term taking advantage of one.
Yeah, and you want to make sure when you are in that type of product that, as my grandfather gave me great advice when I was younger, he said, whenever you get into a situation, just remember you know how to get out of it. So if you get into an arm, you have to have a strategy. So keep your debts paid on time. Make sure that you keep your house in good order. So in case you had to move or have it appraised, and give yourself an opportunity that if you had to refinance, you could. You don't want to be stuck in something that is potentially escalating every year because as easy as it can go down, it definitely can go up too. So we talked a lot about product and certainly reasons you might want to refinance and different products that are refinanceable. And we even talked a little bit about economic factors when you think about refinancing decisions. So maybe we should talk a little bit about more the practical side. So what are the steps to refinance a loan? How is it different from how I did when I was buying my house?
It's not entirely way different, I would say. It's still a lot of the same underwriting. Really the steps are first, speaking with a loan officer, somebody like know and trust. Making sure that, you're going to be saving money or you're going to be able to pull the equity out that you need to pull out. But simply put, like, once you decide, hey, I think this is right, we get a good idea of like what the value of your home is. You'll go into process. One of the first things you'll do if you don't qualify for an appraisal waiver, an appraisal will be ordered. So, an appraiser is going to come out to your house, and mostly what they're doing is confirming that the value of the home is supported by comparable sales in your area that have sold, recently, to determine what the value of your home is. And then, from there, it's just, going through underwriting, uh, reviewing your income documents, your credit, and then closing thereafter.
You touched on that a little bit. What documents do I need to refi? You have all my stuff. You just did my mortgage 4 years ago. What do I need to give you again?
So we're gonna need a couple of years of your W-2s. I'm sure things have changed with your work history. We'll need a month of your recent pay stubs. Um, And then outside of that, I mean, your current mortgage statement, credit report, making sure your payments are on time and that you qualify for the loan. And those are, pretty much, we just need to keep the file updated. We do have a lot of that stuff still, but, we need to keep the file updated and making sure that you still qualify.
All right. So, Grant, so I called you for refinance and I immediately don't have to make another mortgage payment, right? Until you get my new loan. How does
I
that
always
work?
give my members the advice that they're going to want to continue to go ahead and make any and all payments that they currently have on time until we close. What's going to happen after we close your refinance is that you, as the member, are going to experience a month worth of payment skips. So if I closed your loan for you in June, you will skip a July payment completely, and that your first payment to me will be due in August in that example. But until we get to the point of actually closing the loan, please continue to make any and all time payments to your mortgage. If you decide that you don't want to do that, which we've seen before in the past, that could put your refinance in jeopardy, as now perhaps maybe you have some late payments and a credit score change and things of that nature. So continue the course, stay true to what you've been doing. And if you have any questions or concerns, please ask your loan officer before taking any actions. Those couple of minutes can really save a lot of time and agony.
I would only challenge one thing. You can't use the word skip. You just don't make it in a formal fashion. It is part of your closing prep. Is you never get a day off of interest when on your mortgage, one to the next. So, but it gets collected at closing. One of the things that you said, and I think is a really important point, is that you're generally not eligible to refinance your mortgage to a traditional conventional mortgage if you've been late in the last 24 months. You certainly want to make sure making your mortgage, and by late, I mean more than 30 days, something reported on your credit. So always refer to your loan officer if there's been an issue in the past on what that looks like. And they certainly can be more direct in looking at your certain situation to see if you're eligible. But ultimately, making a mortgage payment is a big deal, and making it within the month in which it's due is super important. So, Michael, there's one of my points I was going to make here. Is there, or what is the most common mistake that people make when they're refinancing?
Well, one thing I was actually just going to mention is, once you find out how much money you're saving, don't go out and buy that car mid-process. Wait for the loan to wait for the loan to close. I don't know if that's like the number one mistake. Um, as far as like mistakes being made, I don't know. Are you trying to get at something? I
No,
can't quite.
no, I was
Uh,
just I know in when I want to buy my home, a lot of there's a big thing between application and closing. I remember telling a lot of people like, hey, don't make any major purchases. Is that I guess that holds the true for
yeah,
refinancing too, is that
right.
piece? Yeah.
Yeah, they're, like once you're in process, we are doing, credit monitoring on you. So if you do go out and buy that new car, it's something that's going to get factored into your ratios. And I mean, at times it can actually knock you out of qualifying, if you're in a kind of a tighter scenario. So definitely something to look out for. Um, other than that, I mean, I think the other mistake you make on a refinance is like making sure that you're working with somebody that you trust, because like, I mean, I get calls from lenders all the time and they're trying to tell me that they can refinance me into a better rate. And, there's a lot of, there's some bad players out there. They may be charging you a lot of points up front. They may have very high closing costs. So, making sure that, anyone that you're working with, somebody that you trust. I think another important thing is like really, ask for that loan estimate, ask for the fee sheet, seeing what they're charging you. On a loan estimate, I think, section A is really important to look at. The other sections on the loan estimate generally there's not going to be too much of a difference with different lenders. A lot of that stuff is set just by, your property, your situation. But, when you start seeing some of those closing costs in section A, you should question that because, if you're paying a ton of money up front, you got to think about that break even point. Okay, cool. I'm saving $100, but I'm paying, an extra 5 grand for the rate. Does that make sense to you?
At the heart of this, every lender is selling the same thing, which is money, right? You're selling money, and the cost of money doesn't really differ from one source to the next. The fees in which they charge do, and their access certainly to programs are different through financial institutions sometimes or versus a broker and going through that scenario. So certainly I think we've really drummed on that issue today is this trust. And I know that's when it comes to finances is a hard word, but ultimately you have to believe that your financial institution has your fiduciary best interest in mind when you're in this process. So, Grant, how do you compare multiple lenders, or should you? And I mean, if somebody's giving me something that's too good to be true, how do I guard against that?
Well, it's a deep question, as they say. So when we look to compare lenders on what they're able to offer and be able to close on a loan, a couple things to keep in mind. And we beat this drum quite a bit, right? You have to go ahead and do business with somebody that you feel has your best interests at heart. There, to your point, Dan, are sometimes bad actors out there in our business and that don't have your best interests at heart. At the end of the day, it's more than just the rate, the cost to do the transaction. It's, does this person see my vision of what I want to do with my refinance? The cash out to go ahead and consolidate the credit cards that have been keeping me up at night, the money I need to put away for my daughter's wedding that's coming up, the cash that I need to send my son to college for his first semester. And then, of course, the ancillary things around that that come with your mortgage. You can't put a price on the fact that one lender is going to sell your mortgage servicing 20 different times during the life cycle of that loan. I can't put a price on the fact that you get a letter every 2 months in the mail that says now you got to go ahead and make your mortgage payment to another guy. To me, I think those small things, such as I always know where I need to make my mortgage payment. I always have a relationship with the gentleman or the lady that went ahead and closed my loan. And I have a free book of advice anytime I need to by one telephone call is worth far more than the difference of 50 cents on one fee versus another. So when it comes down to it, I guess those would be the things that I would look for. That person that has my best interests at heart, that I can trust and know that we can go ahead and accomplish the journey together.
I tell our salespeople that if somebody calls and says, "What's your rate?" and if you answer that question, you're doing a disservice. You have to educate the consumer through the process that rate is important, but it's driven by multitude of things. I think there's 12 or 13 fields in our pricing engine when our loan officers run that comparative analysis. Credit score, LTV, all of that, payment history, all of those things go into that to determine what the best rate options are and programs for our members or people that are looking to become our members here at Michigan First. So, Michael, what would you give? I think, if I'm considering paying off debt, and I know we've touched on this a little bit, but it can't all be pros in using my house to pay off my credit card. So what would you say are the pros and cons of using cash out to pay off debt?
Well, I mean, I think the pros are just lowering that monthly payment burden. Like if you are in a situation with very high credit card debt, and you're struggling just to make the minimum payments, I mean, that debt is just going to continue to increase. I mean, I think the con with it is, I mean, you are rolling it into, an installment loan, like a mortgage is in a way an installment loan. So, instead of, having the ability to pay it off quickly, you're rolling it into maybe a 30-year mortgage. So you have to think about that and you have to weigh those options. But I think the other part of it is like, realistically, if I'm only able to make these minimum monthly payments, like, am I ever really going to get out of this hole? Because at that point, you're kind of like in an unlimited installment loan. And I mean, I think the other thing too is like I kind of look at that too when I'm quoting like a cash out refinance or consolidating debt. Sometimes those installment loans, you don't want to touch them because at least there's an end date that's maybe a 2 years out. If you're going to
Yeah.
roll a 2-year installment loan into a 30-year loan, I mean, it may look great on paper because your monthly burden is much lower, but the interest you're going to pay over those 30 years is going to, far outweigh probably what you have left on the 2-year installment loan.
Yeah, and using your home for that too, the interest can be deductible, so that is a pro.
Yeah.
Another con is that you run up your credit cards again. And then you
Yeah.
have this, you have to change the behavior and really understand what got you into that situation in the first place. And those are hard conversations that, need to be had. And that, the one thing about creating wealth through home ownership is not spending all your equity. So I think there's a very honest conversation that has to happen around that too. Certainly that's a consumer decision, not a loan officer decision, but certainly making them aware, like this really works if we don't encounter that issue again. So,
Yeah.
Grant, does refinancing affect my credit score?
That's a good question. Two things, and I'll expound upon it a little bit. Refinancing the loan itself does not really materially impact your credit score. Here's what you can expect when you go ahead and refinance. You will go ahead and pay off the previous trade line that you had for your mortgage, and a new one will be established. So you will likely see a small dip for about 30 to 60 days because a new account has been established onto your credit report from that standpoint. The reduction is minimal. We're talking single digit points, oftentimes with most people who recover very, very quickly overall. Ultimately, borrowers who do cash out refinances, as we've been talking about before, can pay off multiple trade lines on their credit report at that point, have great increases to their credit report after they go ahead and close, because now you're no longer burdened with those additional consumer debts, and the borrowing capacity that you have on your credit cards now is down to well, it's up to 100%. You don't have any outstanding balances on those cards, which would greatly help you. The expounding part upon that as well, and I hear this from clients from time to time. When we do an appraisal for somebody during a refinance, the new, usually higher value of your home is not shared with your township. It is not shared with your city by any means. So your taxes will not go up the way that they did potentially when you first purchased that home. The city has their own way of assessing the property value. The appraisal that we would do would be for our needs only. So rest assured, you don't have to worry about your taxes and insurance going up astronomically.
Yeah. A refinance, what you're saying simply is a refinance doesn't trigger a sale or a change of ownership on your property, just a
Exactly.
transfer of the debt from one lender to the next. Yeah, cool. And I think so if I pay, well, I think if I pay points, and can I buy my rate down on a refi? And is that tax deductible? How does that work?
Oh, let's talk about that. So, great opportunity to go ahead and put yourself in a better situation. So, let's talk about what discount points are. One discount point is equal to 1% of the loan amount that we're talking about. So, if your loan's $100,000, 1 point to you is $1,000 in additional costs, which we can roll into the mortgage for you to allow you to get a lower interest rate than you would normally get in the marketplace. The cool part is the IRS allows you to take a tax deduction. Now, first, anybody who hears my voice, please go ahead and visit with your tax professional prior to doing this. However, any discount points you pay on a purchase transaction, the IRS allows you to take those discount points as a lump sum tax deduction in the year that you close on the home. If you purchase discount points in a refinance, you may take those as a deduction over the amortization period of the loan. So, example, you pay $3,600 in discount points to get a lower interest rate on a refinance, and it's a 30-year loan. You're getting $100 every single year as a tax deduction, saving you a little bit more time and money paying taxes at the end of the year. So,
And certainly any of our loan officers, and Michael included, would be able to walk you through whether it makes sense to prepay interest or not. And he walked you through a little bit of that before, when you just take the payment before and the payment after and run it over the time of the loan. And he might say to you, or do you plan to be in this house more than 7 years? It makes sense to pay it. Or maybe the break even is 4 years. It really depends on the rate discount that you're buying. So certainly great math to run through, and one of the options in your refinance. So we are getting near the end of our time. So my last question is going to go to Michael. Michael, what is the best time of year to refinance? Is it May? Is it June? When is the best month?
It does seem like the fall is generally usually when it really picks up on the refinance. I think rates usually traditionally come down. But I also think maybe that uptick in volume is, folks maybe saving for Christmas, buying gifts around the holidays. What do you guys say on that?
I think there is no best time. I think it's going to make sense financially to refinance is when you should do it, certainly. Grant, anything to add before we close out today?
really to come back to that again, Drum, that we there's, last I checked in the nation, something to the tune of 42,000 lenders that are out there. So there's always somebody that's going to be able to serve your needs. You really need to find somebody that you connect with, that you know has your best interests at heart and is looking to put you in the best financial situation possible. We, being here at Michigan First, a not-for-profit lender, taking care of our members, is a great place to do business. And I would go ahead and say that's really the biggest takeaway. Do business with somebody you can create that relationship for life. Have that guy, right? Everyone's got that guy in life,
Or
right? I got
girl,
a
yeah.
guy, right? Be that person. Find that person that connects with you. That'd be my best takeaway.
Michael, what's your final thoughts?
Grant kind of hit the nail on the head. Um, you know, Before you make a decision, like make sure you're working with somebody that you trust. If somebody just called you up out of the blue and you never talked to them before and you have no idea how they got their number, selling you something that sounds too good to be true, chances are it probably is.
Yeah, I couldn't agree more. We have a stable full of young men and women and experienced men and women that live every day to help people realize their dream of ownership. And then once they're in, save money and use that to fund the rest of their life. So we appreciate Michael and Grant for joining us today. And I want to just close this out with a few things of information today. If you have questions about the entire home buying journey or particularly this webinar that we're doing today, you can email us at info@michiganfirstmortgage.com, and that will come to me or to Zareen. If you want to speak to any of our qualified loan officers, you can find those there at that web address, michiganfirstmortgage.com/mortgage, or you can call 24 hours a day, 7 days a week at our 365 Live call center. You can say or choose mortgage, and that will get you to somebody live. Or more importantly, if you've liked the information that Michael has laid out for you today, there's his information. And you can shoot him an email or call him direct, and Grant is right after him there. Both of those guys are very experienced and certainly can help out. And we're here to help you. We do have our own insurance company. So if you're looking to save some money, and we absolutely can help there, just call our call center or reach out there at Michigan First Mortgage /insurance for more information. We'd love you to shop your home and auto there for us. And then lastly, thank you for tuning in today. And we appreciate your time. And we certainly are here, whether you're looking to buy a home or you have one and you want to refinance or you need to do a home equity loan. We would love to talk to you here at Michigan First, because we're here for you, just like the last 100 years, as the oldest active credit union in Michigan. Thank you and have a great day.